Hello, everybody. Welcome to today's Silver Log, the second for today. It is the 15th of April, 2011. It's Friday, and have yourself an amazing weekend. Goodbye. I'm just kidding. I don't know why I said that. But do please have a good weekend. And if you're holding silver on the long side, it's been a nice ride thus far. And as I was saying amongst this move higher, I was thinking of a Shania Twain song, and that song was called "That Don't Impress Me Much." And the move within the 20s, it really didn't impress me that much. And I might be a little more impressed now, and I am a little more impressed, but still, I have to see new highs at least to start to be impressed. We'll now go over the trends. The first one is this resistance. During this breakout period, for around a couple of months almost, it always found resistance at this level. And it always found support at this green line. I think that's the 10-day moving average. I don't think it's a 20. I think it's a 10. Either way, that's where the support happened to be. Then it changed in here. Right here is where it changed. The pattern went from always staying in this extremely tight range to going above and below it. And that pattern really came to an end right here. Before, it never got above the trend line, and it really never got below this green average. Now that changed. It was going below the green average. It was going above the trend line. And then the next trend was that of really the only significant correction either through price and or time, which is kind of both. The time was in here, and the price was in here. And because of that, we haven't even really came that close to getting towards a trend line. We're one big major pop away right now. It's still unrealistic that's going to happen anytime soon, but it is becoming more possible. And it looks as if it's just a matter of time before we really even test that level, which says a lot. Now, if we connect a trend line within these 2 points here, what we're doing is we're using a trend line that has the exact same rate of ascent as we were using months ago. The one thing that I notice about this type of pattern is you find resistance in here, which was where I'm starting it from, but you find a higher low, you find resistance again, higher low. And what's happening now is you're having a couple small pierces below the trend line, and now you're at the trend line. And when we look at this further and draw another trend line for support, we come up with, that's not a straight line, but I'm going to use it though. But what we see is a rate of ascent that is greater on the support than it is on the resistance, which is telling us that the buyers are not waiting as long as they were before. So instead of grabbing a price at 36, they'll wait for 36.20 or 36.30. It's showing more strength towards the upside. When I see a pattern like this, where the uptrend line has a higher rate of ascent than the resistance line, the odds favor to trend or to favor the breakout within its current trend, which is higher. I don't know what the percentages would be, but it does seem as if that's what I'm seeing on this particular chart. Now the next thing we're going to look at is the direction within the 50-day low and the 50-day high. This is probably my favorite weird indicator. It's fairly simple because the way it works is it takes the percentage that it is away from either its high or its low period over the last 50 days. And it's not normal, if you use this on almost any type of chart or indice, that you would have it look in this type of harmony. Normally, they'd be if you put the two together, it'd be harder to read. In this case, it hasn't been because the sellers haven't really put much aggression in whatsoever. This big move that went from here to here was the result of a pullback that never even reached 20%. And therefore, it was a very light pullback and it didn't take long before the market made new highs, because whenever the direction from the 50-day high is at the bottom, that means the market is making a new 50-day high. If the orange line were to be doing the same thing, that means it would be making a new 50-day low. We haven't made a 50-day low since in about less than a year or so. It's been a decent amount of time since that has taken place. What I like for this is it can give me indications of breakouts. And what I was using for the most part, at least on this particular chart, is this 10% variable in and around that area. There was this level of resistance on the orange side, and then there was this level of resistance on the blue side. Therefore, when we were in indecision back in August, this could have told you which direction it was going to go. You simply trade the orange chart. If the orange chart breaks out where you'd want to go long on this, you'd actually go long on silver. If the blue chart were to break out, then that would mean a short play within silver. It was the orange that broke out, and it broke out very nicely because it broke through this resistance and it consolidated for a little bit, and there we go. There's a nice breakout pattern for the chart. Same thing occurred in the end of January. Nice little pattern in here. It gets close down to that 10% level, and it makes pretty much a double bottom sort of formation. A double bottom is where you have pretty much two V's together, and the resistance becomes support. And there's your breakout right in here. This is the type of thing that I'd want to see for the blue one to have any consideration for shorting right now. I think the best significant resistance on here is roughly around 8.5%, 9%. So what would be ideal for this to happen is to draw some sort of pattern that can be very easily distinguishable. Usually that would be a break above this line and then come back towards this line, something like this, and boom, there's your breakout right there. That's what I would need to see. But every single time that this blue indicator has been giving us directions for it, you could take one in here because it had a nice lift up to 10, came back down to previous resistance, and then broke out. Now that didn't last too long, and oftentimes from failed moves create fast moves, so the failed move occurred at the end of November, and that brought us to $30 silver, $31 silver. Then after that occurred, if you're looking for another entry point, you have this trend line, and therefore you had this resistance. Where's the breakout of the resistance? In here. That was within the January sell-off. This was only a small gain because what it needed to do was it needed to find support here. That did not happen. So there really hasn't been anything here to state that it's been good to short, from what I'm seeing anyway. Next, what I want to go over is the direction within this. Because when we had this move, we got up to this level here, we consolidated here. I guess you can say that's the same as consolidating here. Then it had to move up to 40%, which is in here. Then it moved to 50, which we're starting to see in here. Just because the last time we went to 50% doesn't mean we're always going to make a top. If we go higher, we would set a barrier for future indications on this chart, where if we go to 80% or 90%, then at that time frame we can state, okay, later on, now if we have any big moves, we can compare it to that. But also, too, within this type of movement, what will happen is the lows and highs will automatically reset or adjust themselves through time. Because when it was breaking out above here in August, what was going on was we were taking the difference from the current price and the low price, and at that time it was around $17 an ounce. As you started to get higher or go higher, it goes from $18 and $19, $20, $21, $22, $23, and so on as the days would expire. And the same is true in here. When it made this low back in January, we started going from 26, 20, then 28, 29, 30. We're over $30 now from the low over the last 2 days, or at least over 29. I didn't see the numbers exactly. However, that's the way it works with time, because if the low on one day is 28 and then 50 days later go by, well, what's the new low? 29, and then so on and so on. Finally, I want to go over this Fibonacci upside chart. I've talked about this a lot, and I'm going to continue to do so because I think it's very relevant. The way this works is you find a range, a market or a chart trades within, that has that can be signified as, yes, that's definitely the low, that's definitely the high. And the one that I've figured to be the best one is the one from $4 and $8. The lows of $4 in here and the highs of 8, which were pretty much touched on 3 different occasions. When you do the calculations for this, you take the golden ratio, which is 61.8%. And within this, you start 161.8%. You take that percentage and you multiply that by the difference from the range. This is $4. 8 subtract 4 is 4. So 4, multiply the 161.8%, and you add that on top of the low, gives us a level of 1047. The way these numbers are decided is you take 161.8% and multiply its previous number. This multiply 161.8 is 261.8. And 261.8 times 161.8 is 424. Then 685, 1109. And then 1800, I think, after that. Not sure offhand. And so on and so on. What's important to know or realize within these levels is that if you fail to find resistance or support where you're supposed to, or you don't find much, then that usually means continuation within the trend, and a lot of times it can be fast. So the first time it got to 1047, and this is the easiest one to break through, like a video game, the first level is so easy, it manages to burst to the next one. So it finds resistance where it's supposed to here. Then it comes back down and finds support where it's supposed to. Then it again found resistance where it was supposed to. This is a higher low and a pierce above this low. And as it's going to this upside part in here, then you can make the realization, well, it's making a higher low. It's having another test. It's ought to break it, doesn't it? Well, yeah, and it did. Right to this resistance, perfect hit. Now, after this move, it didn't find support where it was supposed to. It was supposed to come back here and find support. But it didn't. It's not like it always works out. Life would be so easy if that was the case. But no. We have a fast move to the next one. And it really didn't find support there because it came down to this level. Now, it was a pierce above this level because it was pretty close. It was closer to this line than it was this. Whereas if it would have bottomed, say, right around here, it would have been a pierce below this line. And if it would be in the middle somewhere, wherever the middle would be, then that would be hitting the middle, or a 50% retracement from the two. Then from this level, you hit perfect resistance. You made a higher low, and just like we stated here, breaking above this, the same is true here, and you broke above it. Now, you didn't find resistance here where you were supposed to. Doesn't always work that way. So if you were looking to sell there, well, you didn't get your sell. If you wanted to short, if you wanted to short there for the gain lower, it didn't happen. But you did find support where you were supposed to. You found support in here, and you didn't find resistance here. For the second time, that is. And you pretty much found resistance on 2 occasions, but it was a decent sized pierce below. And as it was going higher, it really had no sell-offs whatsoever. And you found a little bit of resistance here, but only a little bit though, not much. And here we are having nice moves towards here. This tells me we're going here. We're going to this next line. Now, what happens at that line, just playing on a blind level, just knowing that if it doesn't have resistance, I'm going to adjust the message of the market and say we're going to the next one. That's 78. And if we find support, and if we find resistance and we find support here or here, we come back, I'm going to like the chances better that it breaks it. But for now, the message of the market states that we should be going towards this level. Now, does this mean that I'd be a buyer at this time frame when we've gotten 3 nice candles higher? We have an okay amount of room to go towards this level, but at the same point, it can very easily correct either through price or time before it gets there. There really is no guarantee one way or the other. And I think for the most part, if you're buying bullion for the long term or any type of physical for the long term, then I think I think this is a really good time to be buying. If you are playing on the paper market for little gains, I would rather shorten this time frame out to the weekly, the daily, the hourly, and look for opportunities where you can get in for 3%, 2%, or whatever percent gains that you would be looking for. Because for the most part, if I'm playing within this, I want to really have most of my buys down towards here, as I want to get the greater gain towards it. Now, what I wanted to see happen and didn't happen was for this market to come back to support, and then that would just give me an easy technical indicator to say, yep, there we go, now we're moving higher. That didn't happen. And therefore, when you have these gains like this, I basically have no choice but to shorten the time frames, and that's why when I was stating if it could break the resistance, I think it was back at 36, then that would convince me, yep, it's a confirmation, we're going higher. And the same thing would be true here. When you're moving towards in here, at some point you got to shorten the time frame out and state, when are we going to say we're confirmed to the upside? Now within this chart, which is a logarithmic chart, each one of these lines are a little bit greater than the next. I don't know exactly the reason why that's the case, but I kind of like it a lot. If we draw a straight line, or at least a line, from one point to the other, and we compare it to, say, other Fibonacci levels, then we can see here that each one is bigger than its previous. And I like this theory because when you are having gains from a breakout and the gains really don't stop, or any corrections get taken, or any big corrections get back, or they move back to where they were. For example, when you go here to here and then back again, well, the trend still remains up. And therefore, when you have those big breakout gains, it usually is an increase of volatility. And therefore, that's why I like how each single time you go up to a Fibonacci level, it's a little bit higher of a gain from the first to the second. Therefore, a gain of 4 on 10.5, that's a little under 40%. Whereas a gain here of about 16 and change on 31, that's a gain of over 50%. So the gains are a little bit bigger. And the first one on 8 to 1047, that's a gain of under 30%, or around 30%. Okay, before we finish this, what will be a 20-minute video, I'm going to just go over some significant trend lines within this market. I think the big one was this one in here, where the resistance got taken out. If we draw parallel lines, and I like parallel. And the secret that I like to use here is to take the same direction and the same rate for the next trend line on a breakout. Okay, so what I'll do is I'll match it up like this, and then I'll draw the exact same trend line and match it up with the top one. You can see we're at resistance now. We pretty much pierced above it a little bit, but then again, it depends on how you draw the line. It could be an exact hit. It's pretty much all the same anyway. We're at that level. And if an area of resistance is not resistance, then you'd expect to go the next one, which would mean I would be expecting to go to the trend line that connects this level up towards here, and of course this significant 48 level. All right, thank you everyone for watching this video. And as I said on the outset, have yourself a magnificent weekend. Bye-bye.